Hello and welcome to ShortView. Corporate bond markets, already skittish after collapsing energy prices, eroding creditworthiness and the prospect of tighter US monetary policy, convulsed in near panic last week after a debt fund was pushed into liquidation by its manager. Now, some calm is called for. If the demise of Third Avenue's focused credit fund was a proverbial canary in the coal mine, it is arguable that the cause of death was suicide rather than toxic fumes from the pits of the bond market. The fund was stuffed full of exceptionally illiquid, risky corporate debt that is hard to trade even in good times. Bafflingly, the FTF fund had a mutual fund structure entirely unsuitable for that strategy. That makes the debacle look more like an isolated case of profound management failure, as Morningstar called it. Nonetheless, the blow-up should not be dismissed. Whilst FTF's portfolio was unusually junky for a mutual fund, the toxic combination of losses, investor withdrawals, and hard-to-trade holdings is not unique. And the US high-yield bond market is heading for its worst performance since 2008 and its third worst performance in nearly 3 decades. As Carlyle's Claren Road showed earlier this year, even quarterly redemptions are not enough to inoculate a fund when the losses start piling up. Ominously, Stone Lion Capital, a distressed debt hedge fund, also indefinitely suspended investor withdrawals last week. It is unlikely to be the last. The bigger concern, however, is the wider world of US mutual funds, which have piled into corporate debt in recent years. US credit mutual funds have doubled in size since 2010 and now hold about a fifth of the entire market, according to Citi's Matt King, even as their ability to trade their holdings has atrophied. For now, US high-yield bonds actually look a little bit attractive. The biggest ETFs took another pounding yesterday, and the market is pricing in the default rate rising from 2.5% to more than 8%. That looks unlikely, short of an apocalypse scenario, so a tentative recovery is plausible. Yet 2016 is going to be a white-knuckle ride.